Good morning. Today is September 19th. All right. Let me start with some discussion. The latter part of uh, discussion between students and Chairman Bernanke, then Chairman Bernanke, and then we are going to move on to chapter 3. Student, the latter part of your lecture was about monetary policy in the 2000s after the dot-com bubble and how interest rates were kept low. You argued that that was not a trigger to the increase in house prices, but to look at it from another point of view. What is your take on the argument that the low interest rates caused private investors and the banks to make riskier trades, and that could have been a trigger to the crisis? Chairman Bernanke, that is a good question. I think there is some effect of low interest rates on risk taking, but once again, it is an issue of getting the right balance. During a recession, generally speaking, on most dimensions, investors become very cautious. That is certainly where they have been for much of the recent past. You want to achieve an appropriate balance between the amount of risk being taken, not too much, not too little, but once again, that is yet another reason why financial supervision and regulation needs to be playing a role, particularly with large institutions, banks. We need to be looking directly at those firms and making sure that they are managing their risks appropriately. So again, it is a question of the right tool for the job. Student, the graphs on the housing bubble show how clearly one thing led to another, like rising prices and then eventually a fall. When you were observing the economy in the 2000s, what did you think would happen to the rising house prices in the housing bubble? Did you think that it would eventually lead to a recession? There is a book called The Big Short about some investors who were very prescient on shorting the market. What is your take on that? Chairman Bernanke, as I tried to argue, the decline in house prices by itself was not obviously a major threat. In 2005, when I was the chairman of the Council of Economic Advisors for President George Bush, we did an analysis for him on what would happen if house prices came down. We concluded that we would have a recession, but we did not anticipate that the decline of house prices would have such a broad-based effect on the stability of the financial system. When I became chairman of the Federal Reserve in 2006, house prices were already declining. In the first 2 weeks after I became chairman, I gave testimony in which I said house prices are falling. That is going to have negative impacts on the economy, and we are not sure of all the consequences. So we were always aware of the possibility that house prices might come down. The really hard thing to anticipate fully was that the effects of the decline in house prices would be so much more severe than the effects of the somewhat similar decline in dot-com stocks. And again, the reason is the way in which the decline in house prices affected mortgages, which affected the soundness of the financial system and created a panic, which in turn led to the instability of the financial system. So the whole chain of events was critical. It was not just the decline in house prices, it was the whole chain. Student, amid the dispersion of cheap dispersion. Amid the dispersion of cheap credit in the years preceding the housing crisis, there was a bipartisan push for American homeownership, originally spearheaded by President Bill Clinton and later carried on by President George W. Bush. To what degree could it be argued that aggressive government policy supporting increased lending during this period contributed to the eventual erosion of credit standards on behalf of the mortgage originators? That is a very good question. And another controversial one. Certainly, there was some pressure to increase home ownership. There was the American dream aspect of owning a home and so on. Home ownership rose during this period, but to put all the responsibility on the government is probably wrong in this case. Most of the worst loans were made by private sector lenders and then sold for private sector securitization. That is, they did not touch Fannie Mae and Freddie Mac. For example, they went directly to investors. Fannie and Freddie did acquire some subprime mortgages, but actually that was a little bit later in the process rather than at the beginning of the process. But clearly, the private sector, without any encouragement from the government, was a big player in the decline in mortgage underwriting standards and in the selling of bundled mortgages to private investors. I think one of the hallmarks of the Fed under your leadership has been your commitment to transparency. All of us in this room are beneficiary of that policy, but I wonder whether you think too much transparency could actually damage the central bank's credibility if it gets things wrong. Generally, I agree that transparency is very important for at least a couple of reasons. I talked already about the importance of a central bank being independent, so there is one linkage there. But if a central bank is independent and making important decisions that affect everybody, then it has to be accountable. People have to understand what it is doing, why it is doing it, and on what basis it makes its decisions. So, for democratic accountability, I think it is important for the central bank to be transparent. I testify all the time, I give speeches, I have town hall meetings and other kinds of meetings like this. I give press conferences, and I think it is very important for me to explain what the Fed is doing and why it is doing it. The other reason for transparency is that over time, there has been increased understanding that most of the time, transparency can make monetary policy work better. So for example, if the Federal Reserve communicates that its future actions will be X or Y and conveys that information to the markets may respond by building those expectations into interest rates, which may have a more powerful effect in the economy. So communication also reduces uncertainty and helps increase the impact of monetary policy in financial markets. Student, my question concerns price stability and inflation expectations. You mentioned that importance of macroeconomic stability and long-run economic growth. Given the massive amount of liquidity that has been pumped into the market recently, how has the Fed been able to keep inflation expectations so low? It's a very good question. I think we owe something to my predecessors, Chairman Volcker in particular, and also Chairman Greenspan, who got inflation down low and kept it there. It's not a great answer. People get used to what they see, and in a world in which inflation remains low year after year, people become more and more confident that the central bank, the Fed, or whoever will meet its mandate of keeping inflation low. It has been very striking that even though we have had movements in oil prices and other shocks to the economy, deep recession and financial crisis throughout most of the period, inflation expectations have been very well tied down to about the 2% range that the Fed is trying to hit. Now, lecture 3, the Federal Reserve response to the financial crisis. Today, I want to talk about the Federal Reserve response to the financial crisis. In the last couple of lectures, I mentioned a key theme, the two main responsibilities of central banks, financial stability and economic stability. Let me turn it around and talk about the two main tools for financial stability. The main tool the central banks have is lender of last resort powers by providing short-term liquidity to financial institutions, replacing lost funding. Central banks, as they have for a number of centuries, can help calm a financial panic. For economic stability, the principal tool is monetary policy. In normal times, that involves adjusting short-term interest rates. So there are differences in objectives and tools. Can you see that? Two objectives or two main responsibilities are macroeconomic stability and financial stability. Two tools for each goals are lender of last resort function for financial stability and monetary policy for macroeconomic stability. All right. That's it for today.